Happy New Year's, chart watchers, and welcome to this Tuesday, January 2nd, 2018 Market Watchers Live Show with Aaron Swenlin and Tom Bowley. I'm your host, Tom Bowley. Today's show is being recorded, so you should be able to play back any or all of Market Watchers Live at your leisure. If you're unable to attend the show live, you can now go to www.stockcharts.com/webinars, follow the link to Market Watchers Live, and play back the show. Each show will be archived on our site until the next show begins, so you'll have roughly 24 hours to review. If you'd like to review an older show, you can now find those at our YouTube channel or on Facebook. During today's show, please feel free to submit ticker symbol requests, questions, and comments using the chat window next to the video player. Later in today's show, we'll select stock symbols from your requests, and I'll use those in the 10 in 10 segment at 12:50 Eastern Standard Time, where I'll attempt to annotate 10 stocks in 10 minutes. Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. If you'd like to be part of the show, you can reach us via our chat room or Twitter. Our Twitter handle is at Market Watchers Live. That's at MKT Watchers Live. As you leave today's show, love to get your feedback. In the lower right portion of your screen, you'll see a How'd We Do section with a link to a very brief one-question survey. Let us know what you think of Market Watchers Live, and feel free to provide us some suggestions for improving the show. For those of you joining us for the first time today, welcome to the show. We are certainly glad to have you with us today. And for our regulars, welcome back. Just a couple of quick announcements before we get going today. Tomorrow, Everything Stock Charts returns, and Bill Shelby will be with us to go over what's going on at Stock Charts. On Friday of this week, I believe Erin is going to be doing a workshop, and she'll get into that some more later. But just want to let you know, mark your calendar. And next Wednesday, Bruce Frazier will be making a return visit to Market Watchers Live. That's next Wednesday, January 10th. And with that, Happy New Year, Erin. Welcome back.
Happy New Year. I'm very excited to get back. I think you are too, based on our discussions, although you sound a little under the weather.
Oh, yeah. It was not a great holiday season, unfortunately, from a health standpoint. But
sounds like my Thanksgiving with the flu. So I'm really sorry you had to deal with that. But
yeah, I was just going to say, it's kind of one of those things where, being sick over the holidays, you don't want to be sick over the holidays. But we didn't have any shows. So I felt like, okay, well, at least I wasn't missing out on the shows. And it's getting better. My voice is still a little rough, but I feel a lot better than I did last week.
Yes, indeed. Well, you know what? I think I'm going to go straight into the market and let people know what's going on, and then I'll show the agenda.
Sounds good.
All righty. Well, let's get started. What the heck is happening right now in the market? Well, very interesting day, I would say. We're definitely on the upside currently. You can see that the Dow had a great opening, just like the S&P did, as well as the NASDAQ. But notice the pullback on the Dow today. So really interesting to see all these large cap indexes making these really big moves right out of the gate. But now they're starting to pull back, and we can see the Dow is the one having the worst of this. And Russell 2000 is also pulling back a bit there too. We can see that Wilshire 5000 up. Treasury yields are higher right now, reading at 24.63. UUP gapped down, and while it tried to make a recovery, it is moving further down at this point. Commodities up slightly. We can see USO is rising at this point, up 3 cents, 12.04. Gold, nice gap up, but now it looks like we're going to consolidate a little. I can kind of see a descending triangle trying to form here, and that is a bearish formation. So we'll see if we can hold on to this support level where we got gap support on the opening for GLD. The VIX is moving lower. It had a spike earlier on Friday. It was well above 11, which we haven't seen in quite some time. But now we're back down to readings just above 10. So still feeling some complacency. And of course, when you have a nice market opening, not a surprise to see the VIX tumble lower. And we can see advances are leading declines at this time. All right, so that was our quick market review. Let's go over today's agenda now that we know what's going on. And we have, of course, our Monday setups. We're going to get started with that shortly. I know, Tom, you're putting together some. Honestly, I have a group of 5 and I haven't figured out which one it's going to be. So I'll do that after I review them. I think you do that a lot too, Tom. Let's see, the seasonality report. Tom's going to go over the strong and weakest stocks that he has found as far as the first couple of months in the new year. So I think that'll be interesting, of course, 10 and 10 to 1. And our first stock, if you want to take some notes, is going to be Amazon, AMZN. And finally, I'll give you the DecisionPoint report. And I'm going to give you the rundown like Carl did, which is really a year-end DecisionPoint report. So I'll be looking at concentrating a little bit more in the intermediate term and longer term, just to give us a picture of where we want to look for the market to go in this coming year. So with that, Tom, I'm going to turn it back to you because I know that you have more than likely a technical report or two.
All right, sounds good. Yeah, there's a lot going on in the market as we start a new year. Everything got off to a pretty good start, followed some of the markets over in Asia. I know the Hang Seng absolutely exploded overnight, was up over 500 points, and is actually approaching its all-time high from 2007. So I think there was a little bit of a global rally, although the indices in Europe were taking a hit earlier today. I haven't looked at them recently, but they were not really following what we were seeing overnight in Asia. But then U.S. futures were very bright. There was only one economic report out this morning, and that was December PMI manufacturing index, and that came in at 55.1. The market was expecting 55.0, so really just kind of matching what Wall Street was looking for. And so far, based on that, the 10-year Treasury yield, I like to follow what's going on in the bond market because I do think the bond market tends to get it right more often than the stock market. But you can see the yields rising, meaning that we're seeing a sell-off in treasuries this morning. So that's helping to fuel the stock market advance here, which I think is bullish. But looking at this, and there's actually another chart that I'm going to show you here. First, I'll pull up the TLT, which is the 20-year Treasury bond ETF. And you can see that we've just been sideways consolidating throughout the second half of 2017 with a high, really a double top, triple top, whatever you want to call it, around 128. And then multiple lows down around 121, 122. And we keep going back and forth. We're down today here, and you can see that that's put us back in the middle of this range. And then the TNX, which is the yield on the 10-year Treasury, moves in the opposite direction of bond prices. And you can see the 10-year Treasury yield is moving up today. We've been in this little uptrend for the past few months. Just recently, in December, we put in a new high. We took out the high that was established earlier back in October. So that's a good thing. Anytime you get into a series of higher highs and higher lows, that's a good thing. Now, you might say, well, why is it good that interest rates are rising? Well, keep in mind, number one, that we have historically low interest rates still. We're pretty close to the historic lows. So I think the rising rates can still be handled by the economy. I don't think that a little bit of a move into the upside in yields at this level is going to do anything to thwart the economic growth that the market seems to be forecasting as we head into 2018. So the way I look at it is the short-term moves to the upside in the yield is actually money rotating away from treasuries and into equities. So I always like to see this yield in the near term moving higher. And so far, that's what we're getting today. Now, as we start 2018, for me, looking to see, is this market sustainable? Are we going to continue to go higher, or is this just something, that just has to end? Well, based on everything that I look at, and I'm going to go into into a chart list that I keep where I have all of the various ETFs on the sectors, and I like to compare them against the S&P 500. I just look at these once in a while, maybe once a week, maybe once every couple of weeks, just to make sure I haven't missed anything. Chances are, if these are breaking down, I probably know about it looking at the market every day. But still, I think it's helpful to go back and just take a quick review. So here's the XLK technology. The top chart here is an absolute chart. So this is just telling us what the XLK has been doing. It's been continually rising, and it's been doing it now since the beginning of 2016. So we got 2 years straight up pretty much for technology and really no end in sight at this point. And you can see that the relative strength, this is a chart of the XLK relative to the S&P 500. That continues to move up. Yes, for about the last 6-7 weeks, we have been downtrending, slightly underperforming the S&P 500. But if you look, that's just normal. We move up relative to the S&P, and then we give some back. We move up, give some back, move up, and now here over the past several weeks, we've been giving a little bit back. But technology continues to perform extremely well. We move on to the financials. Financials on an absolute basis continuing to move higher. And you can see on a relative basis, we actually made a breakout in November, taking out a triple top. So I think that the financials continue to look really strong. And as yields rise on the 10-year Treasury, profits tend to move higher in some key areas of finance, including banks and life insurance companies. So as we see the yields continuing to move up, I would expect to continue to see strength in this particular ETF, and especially in that banking area and life insurance. Moving on to the next one, industrials. Again, absolute basis look very strong. And on a relative basis, we had a pullback back in October and November. Money rotated out of the industrials for a bit, but you can see we've come back very strong, putting in a new high. So there's really nothing not to like about the industrials. Consumer discretionary, big move to the upside. There's a huge rally the last couple of months, led mostly by retail. And after sideways consolidating on a relative basis for a few years, I'd be watching the top of this relative chart, because I would not be surprised to see consumer discretionary take off to the upside. I'll be talking about some seasonality later, but we've seen a breakout recently in a lot of retail areas, and retail tends to do extremely well February through April. So we've got that kind of sitting in our back pocket from a bullish perspective. So those are the four aggressive areas that I like to look at. And I get nervous if the market's going up and these four areas are not looking very strong. But I think based on what we just looked at, I would make a very strong argument that the bull market that we've seen for almost 9 years now is very sustainable currently. That doesn't mean that 6 or 9 months it'll be sustainable. We'll have to continue to watch the action. But right now, I really don't see a whole lot to slow down this market, other than the fact maybe we're just temporarily overbought from time to time. So maybe we hesitate. But this is a market, to me anyway, that looks like it wants to go higher. There were a few upgrades out today. I wanted to go over a couple of those. TITN, which is Titan Machinery. You can see beautiful move to the upside. Came back down. Looks like it's kind of putting in a cup. Today they were upgraded. It's kind of interesting to me how a stock makes a move from 13.5 to 23 in about 3 or 4 weeks. And then after it settles down for a couple of weeks, then the upgrade comes out. I haven't followed a whole lot of, I don't know about the number of upgrades, downgrades that have come out on TITN recently, but I did find this one to be kind of interesting. It looks to me like it's trying to break out of this little sideways channel here now based on today's upgrade. A solid finish, I think, would be bullish on TITN. INCY, this is a biotech. Beautiful move to the upside and off of this downtrend for the past 4 months. This is kind of interesting because we're taking out the recent highs. You can see that the MACD has turned up, still below the center line, but pointing higher. And the other thing, we're going to talk quite a bit today about seasonality, but I'm going to just pull this one up, INCY. And if you go back the last 20 years, you'll see that in January, this stock average is going up 7.1% in January over the last 20 years. That's pretty significant. So I thought that one was worth mentioning. JWN in the retail space, Nordstrom's. You can see this triple top breakout today with an upgrade. Volume starting to pick up. I thought that one was noteworthy. Netflix. I'll talk about this more about this one on seasonality as well. It's very bullish at the beginning of the year historically, and it got an upgrade this morning and is following its historical pattern, moving higher in January. SYK, this one was upgraded. This is on my strong earnings chart list after a big move up with earnings at the end of October. Stock went down almost all the way back down to fill this gap, and now is starting to turn back higher again. I think SYK looks particularly interesting. 3 downgrades I thought worth mentioning. COG, this is Cabot Oil. Notice that after gapping down, it actually is back up today. I think this is typical when you get a stock that's up, trending higher. You get a downgrade, you get a gap down, but then the buyers come right back in. And so I think COG looks kind of interesting. Siri is a little different, though. Sirius Satellite or Sirius XM Holdings. After a big move down on heavy volume a couple of weeks ago, notice the failure as it comes back up. It fails at the 20-day moving average, starts to drift beneath it, and then the downgrade comes. And so with increasing volume today, this is looking like a pretty significant breakdown on Siri. I'd like to see a strong finish today or I would not be surprised to see further weakness in January on Sirius XM. Lululemon Athletica, you can see it's another one of the retailers downgraded today, but look at that candle. I mean, straight back up after the open. To me, a lot of times, and Aaron and I talk about this a lot, you get these downgrades, and sometimes they're just great opportunities to get in during uptrends they provide. Now, this one didn't test the 20-day. I'm not saying that was a great entry necessarily at the open, but a lot of times these pullbacks on downgrades do represent some pretty nice opportunities.
Hey, Tom.
Yeah, go ahead.
Can you expand your screen? We're seeing your whole desktop. I don't suppose you could share just your chart so it'll be bigger.
Okay, well, I was going to go into the and I will. Wondering if you want to just go into the Monday setups and take it.
Oh, there you go. Yeah, that will work.
I was ready to turn it over anyway, but yeah, I'll try to fix that.
Okay, no problem. All right, so let me get to my setup screen here. All right, so I ran my scan as I always do, and I have the link to that scan language at the bottom of every Market Watchers Live recap, the recap blog. So if you go to the very bottom, you'll find this PMO scan. And for extra members and above, you can go into the scanning workbench and just copy paste, and you'll have this exact scan. It came back with 10. This is last week's pick. So I actually pared it down to 5. So I cut out 50% of them. And usually it's just not the best setup. And I do like to be picky because there's always a good setup out there. And those just weren't good enough. Let's put it that way. So let's look at my Google chart because it was down. What happened to us both, I know you'll agree, Tom, is that, we got these breakouts. See, this is when I made my quote unquote Monday setup, but then we had to hold it for like 2 weeks instead of 1. I don't think it would have helped me that much because we're already back to that area of support, which is about where I think I had it in. So down just slightly, but you can see how the chart just went south pretty quickly. So that's why if I'm in it, I got to watch these very closely. So anyway, let's look at the 5 that I was looking at. I really have struggled here, like I said, to try and pick which one, but I think I've picked the one that I want, but this one isn't it. Air Products and Chemicals, APD, came up on the list. I thought this one was very promising. We've got that breakout. And if you look here in the thumbnail, it intraday got up here to that 165 level, and now it's starting to pull back. So I think that's looking good. You want to see that pull back toward the breakout point. We've got a nice PMO buy signal now. Look at the OBV and the scooter moving very nicely with this particular rally. So you could also make a case here for a double bottom after this area of consolidation. And that would be a breakout right there from a neckline. And the size of the pattern would probably put us at, I'm not sure, probably about 167 or so is your target. So that one I thought looked pretty good, but it's not my pick. Chart Industries. I thought the name was pretty cool since we do charts here. GTLS, Chart Industries. Look at this beautiful breakout. The PMO is turned up. We don't yet have the buy signal, and that's usually when I like to get in on these. You've got the OBV rising so nicely. Look at that strong scooter. So lots of internal strength going on here and that really nice breakout. I did not pick this one. I think this one has some really great upside potential. I didn't pick this one for my Monday setup, mainly because this is an edutainment sort of thing. As we talk about, I would want to wait for the pullback toward that breakout point if I were going to consider it as an investment. I think this has some great potential. But as far as making my pick, it's up 2.65% right now. I don't want to go in and quote unquote bet on it making it and passing up this overhead resistance. It's already kind of made its move, I think. But watch that one. I think that one will be interesting if we get a pullback toward that support area. Mccormick Company. This one I almost picked, but as I continued and watched this intraday, we now got a PMO top below the signal line. So when I originally ran the scan, it was looking okay. The PMO was rising, but no longer. And not surprising when you see this drop, but we are in a rising trend channel. And it's been intact, since the first part of December. And it's come down here. It didn't quite test it, but I think that's positive. It didn't have to go all the way down, and it started back up. So I think there's some potential here, but I didn't pick this one. It just wasn't the setup I wanted, mainly because of that PMO change. And I'm going to skip UFI because that is going to be my pick. UPS, here's another one with a really great breakout above overhead resistance. It's been in place since the beginning of October. And I think there's a lot of upside potential here, to get up to this previous high back in early December. And the PMO was a little bit indecisive, but it's decided to move up at this point. And I like the volumes moving up on the OBV. The bottoms are rising, and the scooter is now ticking upward at this point. So I think UPS looks pretty good. But for the sake of the Monday setup game, as I consider it, you can trade off our setups, but I consider this more of educational segment. So I don't necessarily, when you get these setups, it doesn't always mean that you want to go right out and buy them. But I do want to give you these for food for thought. So right now, I was really struggling with this one, mainly because we do have a breakout, but let's face it, it's a really teeny tiny breakout. But I just feel like there's some good potential to get up to this 38 level now that we have had that breakout. And you can see that the 5-day EMA here in the thumbnail crossed above that 20. So that's giving me a short-term trend model buy signal. So in the short term, I just got a buy signal. I'm about to get a PMO buy signal. And I have this, albeit tiny breakout, but I think the upside potential to 38 and maybe even 39 is there. One caution is this is a very low volume stock. So that's also something to consider. Sometimes the volatility can be a little difficult. So those were the ones I had, Tom. And I think I split the time right in half. So you certainly get plenty of time to go through yours.
Okay, so I have you down for UFI at 35.98.
Yep.
All right, in the books.
All righty.
Yeah, I also had a problem with, and these are going to be my stocks here in just a second, but last week or 2 weeks ago, I guess, my pick was GNRC. And actually, if we continue to reverse, I actually like what's going on today because I think we could have an inverse head and shoulder off the top here, left shoulder, neckline, come down, put in lower low for the head, come back up, basically equal for the right side of the neckline. We pulled back today on fairly light volume. Today, volume's picking up, but we're also bouncing off the low. So if we continue to strengthen in the close, I kind of like this candle. But I'm looking at inverse head and shoulder. I'm also looking at possible cup off the uptrend. So I'm still okay with GNRC. But 2 weeks ago, when we did have it out here, and I think I had it for 2 weeks. I think maybe the 11th I had it. And then also on the 18th, I kept it. So I actually kept this one for 2 weeks. It was doing fine until last week on light volume. It just started drifting back down. And so I think you probably, if we go from a 2 week perspective instead of a 1 week, I think we were both down, but I think you were probably down less. So I'm going to give you last week.
Okay.
To close out 2017, I'm gonna say you win that one with a little asterisk. That's just competitive nature in me coming out. No, it was tough because the market overall the last week really didn't play like it normally does seasonally. I mean, it wasn't a horrible week, but it wasn't a whole lot of strength in the market. We just kind of floundered really since about the middle of the month. But it did hold on to the majority of the gains that we saw throughout 2017. So I guess that was a good thing. So anyway, GNRC was the one I had last week. I still like this stock, though. I think as long as it continues to hold $48, that's where I think that's a really big level. That was your gap up on volume back in October. That's right before we moved to 54. We've come all the way back down. We've tested this 48 level on multiple occasions. So I wouldn't want to see a close below that. Otherwise, I think it looks pretty good. So let's take a look at this week's setups. And this is the one I put in my blog this morning. This is the one I was going to go with. but the thing is up $8 now. So to put it out now is just, I can't do it. So I'm gonna
Oh
have to,
man, I got to change the chart that has the summary chart.
change it because I can't do it. I mean, I just can't go with a stock that now is $10 off of support.
Yeah.
But it was a good pick for this morning, but not so much now. So this is still a nice looking chart. I still like the target up here around 283 or so. But if you're going to keep a stop close to 255, there's also a trend line if you go back further that comes up and I think intersects around 251 or 252. But you can see this 255 level and how many times we have tested it or gone below it intraday to hold it by the close. And we had closed right above that level on Friday. So I had this one all ready to go. And then it just moved too fast on me today. So I'm going to pass over that one. Move on to Red Hat. This is not going to be my pick, but I do like it down here at about the 120 area. You can see again multiple tests of this support level over the last 3 months. This one I probably would go with. I think it just needs more consolidation after gapping on heavy volume below the 20. You can see we haven't even had a 20-day test yet. So I just think it needs to go through a little bit more consolidation. I like the support level, but I just don't know if it's got enough pop in it at this point. So I'm going to hold off on that one. This is the one I'm going to go with, NAV, and it's also having a pretty good day today, up 1.84%. But I love that big volume gap up. We came all the way back down to gap support. I was hoping I would get it closer to that 42.5 level, but I'll get it a little higher. So 43.67 is where I will get into Navistar. And I'm looking for a return visit of that 47 level back toward the top of that black candle from the 19th of December. And then to the downside, I would really watch this gap support level. You've also got the rising 20-day moving average coming in just above that. So that would be an area to watch to the downside, but I'd be looking for a return to $47 or so on Navistar. I did have a couple of other stocks on my setups for this week, so I'll go ahead and pull these up. JEC, that is at 66.68 right now, and this is another one that gapped down on decent volume, kind of consolidating right above this rising 20-day moving average. I wouldn't be surprised to see this make another run at $68, $69 to challenge those December highs. And then my last one I think that I had was Marvell. I loved this heavy volume move back here. And you can see that Marvell on an RSI had reached 90, which there's no way I'd ever buy a stock with an RSI at 90. I wouldn't buy one with an RSI at 80. And I don't like buying them with 70. So I'm certainly wasn't going to do that. Those blue mountains just tell me the stock needs to consolidate for a while. We've been seeing that for about 6 weeks. Volume's been coming out of the stock, and it was back down near one of its gap support levels. I think this candle right here between about 2075 and 2150 is pretty good support. We've seen a couple of moves down to test the top of this area. We saw it again earlier today, bouncing off of it. So I think Marvell looks kind of interesting. I wouldn't be surprised to see another move up, for, heading toward 24 to test the November high that we saw about 7 weeks ago. So those are the ones that I had today. Now I do want to get into some seasonality. And actually, before I do that, let me backtrack just for 1 second and just
I want to show everybody too what we looked at today.
Okay. One thing I want to do is just pull up on the blogs. Oh, you already took the screen.
Sorry, I stole it from you. I'll be really fast, but I just wanted everybody to know what setups we did go through. Tom's pick at 43.67. I hope I got that one right. NAV. And then here are the other ones that he looked at. And then I had the pick of UFI at 35.98. And these were the other symbols we looked at. I'll have this chart ready for you in the Market Watchers Live recap after the show.
All right, awesome. Actually, while you have the screen, why don't you pull up the S&P 500 if you can?
All right, I can certainly.
Before we get into the seasonal, I just want to take a look. And I think it was back on. I actually did a study over the weekend while I was sick and not doing anything else. I figured, heck, I'll go ahead and take a look at this October 28th to January 18th period on the S&P. And if you pull up, well, I actually just pull up a regular chart on the S&P.
There we are.
And if you hit that inspect button at the top, I just want to go back to October 28th and see if you can get a close on that.
It was,
well, 27th.
27th. Okay, so the close was 25.81.07.
All right, so 25.81.07. 0.07. And where's the S&P right now?
The S&P currently, the last reading was 2690.29.
All right, so I'm doing a real quick calculation here.
Not a bad quarter.
Yeah, so the S&P 500 during this period right now is up 109 points. And if I take that 109 and divide it into where we were to start back on October 27th at the close, we are up 4.23%. And you might say, well, why are you calculating it from October 28th? And I'm going to explain that in just a minute.
Well, 27th.
Or 27th. Normally it's the 28th.
Yeah.
Actually, normally it is actually the 27th on the close. So we got it right there. So 4.23% is what we're up right now since October 27th close. And what I had done, and I'm going to go ahead and pull up, and I'm going to just share for now a spreadsheet that I did.
Oh, your spreadsheets. I know people always want them.
Okay, so you probably, hopefully you can see this now.
Yes.
What I did is I took two periods. I took October 28th to January 18th. And let me zoom up this a little bit, maybe make it so everybody can see it much better. There, hopefully that's better.
There we go.
So October 28th, that should be, no, October 28th. All right, I've been a little under the weather, so I'm still trying to get back into things here. Not sharing my screen right.
It's okay.
Can't read correctly, but I'll get back into it. Anyhow, October 28th to January 18th is the first period, and then January 19th to April 18th. And what I was trying to do was, first, I already know from history that one of the strongest, the strongest 3-month period, or roughly 3-month period in the stock market or on the S&P 500 since 1950 has been October 28th to January 18th. That has been the strongest period. So what I did is I went back and calculated all the prior years since 1950 for just this period, and I segregated them into different quadrants. The first quadrant being the best years from this October 28th to January 18th period. So for instance, in 1963, from October 28th, 1962 to January 18th, 1963, the S&P 500 rose 19.51%. That was the best period. That period was the best in 1963 compared to all the other years. And what I've done is I've calculated this for every year, and I've got them in order from best to worst. So 1963's period was the best. 1999 was second best. 1971 third best, and so forth. And then I broke them down into quadrants. So these are the top 25% of years, looking specifically at that October 28th to January 18th period. And then what I wanted to do, and here's the second quadrant. You can see it, going down each quadrant. Here's the third quadrant. And then finally, here is your last quadrant. So these are the worst October 28th to January 18th periods. And when you look at these, you might say, well, what the heck does this mean? Well, one of the things about the stock market is, we tend to think, well, market's gone up too much, you can't go up any higher. But what this study showed me is that when you look at the following 3 months after this period that's been so strong, take a look at the averages. So that when we look at the top 17 years of October 28th to January 18th performance since 1950, here are the best years, they've averaged going up during that period 11.41%. The next 3 months have averaged going up another 5.79%. And when you look at the other quadrants, 6.77 versus 230, 265 versus 303. And then finally, the worst, you think, the worst ones maybe will bounce back, but really we don't. The strength continues mostly in years when we've had these big run-ups. So, and I think this is really a testament to technical analysis and why it's so important, because I think common sense, if you think, okay, the stock market's gone up 11% in less than 3 months, it needs a pullback. But that's not really what happens. And when you look at the next 3 months and look at only 1980, this was the only one that had a really strong year in this top quadrant that fell apart over the next 3 months. We've had there were a couple of other fractional losses. 1992, slight loss. 2004, slight loss. 1997, minus 1%. And then here in 2000, minus 0.93%. So a little less than a 1% loss there. But look at this one went up another 10%. This went up another 10%. This went up another 16%, 16%, and 17%. And if you look at these double-digit gains for the period January 19th to April 18th, you see how there's 6 of them in double digits here, or actually 5 in double digits, and here's another 9.97. So roughly 6 of these are in double-digit gains after we've just had huge gains. So, and if you look down, tell me all the other 10 percenters you see here. I don't see any in that quadrant. I don't see any in this quadrant. Well, there's one, 21%. That was 1975. And then you get to this bottom quadrant, and there was one back in 2016. So my point is, when the stock market is hot, the tendency is that it stays hot. It's very unlikely that we're going to see a huge move and then a sell-off. Now, we just did a calculation that with about 16 days to go in this period, because right now it's January 2nd, the S&P is sitting up, excuse me, sitting up 4.23% right now, which does not place it in the top quadrant, but it does kind of place us right in the bottom of the second or top of the third quadrant, where we do tend to see continuing movement to the upside. It's not quite as strong as we've seen before. There's the average 2.3% additional gains looking out the next few months. And then here, average another 3%, although if we took out that 21%, obviously that 3% would not be there. It would be a much lower number. So my point is, though, that we're kind of sitting right now in the middle of these quadrants. If we make a big run here heading into earnings season, we could start to move ourselves, much further up into this second quadrant. We'd still have quite a bit of work. We'd have to go up probably another 100 S&P 500 points to make it into this top quadrant, where we tend to see continuing strength down the road. And I'm not trying to say, hey, use this to make your investing decisions. What I'm trying to say is that when you see seasonal strength like this heading into a new year, you tend to see it continue. And I know that kind of goes against common sense when you look and everybody's saying how we're so stretched and we're overbought and we need to pull back. History tells us that normally doesn't happen, that actually we tend to get more overbought. So I wanted to start with that. And I thought I think if I switch over, you're going to lose my screen, but let me check and see.
I should be able to do a new share.
Well, I don't want to stop the share though. Why don't you take the screen for a second?
No problem. Alrighty, let's go here.
All right, let me grab this right back. And all right, now you should have my screen of the S&P 500.
Indeed.
So I wanted to take a look at some stocks and some industry groups that tend to perform pretty well as we head into a new year. The first group, and this is the best performing group over the last 20 years in the month of January, home builders. Home Construction Index. And the group has already been on a tear. And believe it or not, we can pull up, let me pull up the seasonality on it first, and we'll come back to the chart. This one kind of goes against common sense as well. You wouldn't think home construction would be so strong at the end of the year and early in the next year during the winter. You would think that maybe it's spring, that the anticipation of the season would really start to kick in. But if you take a look here, November and December, up 3.1%, December 5%, and then January another 3.5%. This is over the last 18 years. This is an average. And you can see that 71% of the time, home builders go higher in January, 78% in November, and 72% in December. So this is a group that, for whatever reason, during the winter months tends to do extremely well. Now let's take a look at that chart. And on the daily chart, I would say, we got very overbought. We've pulled back. Well, we went sideways for a little while. That allowed the RSI to pull back a little bit. But I'm more interested looking at a weekly chart. And when I look at the weekly chart, you can see that this move up has resulted in a MACD that has gone straight up into the stratosphere. But we are extremely overbought on a weekly chart. And a normal 20-week test, which really wouldn't be that big of a deal, during an uptrend, hitting a 20-week test. That's sitting right now down at 850, and we're at 935 on the index. That's almost a 10% decline just to get back to the first level. So home builders going into January tend to do really well, but there's a significant risk factor in getting into this group right now because it's made such a huge run up into the beginning of the year. Instead, I would keep this information kind of parked in the back of my mind. And if home builders do go through a rough period for a week or two, where they get a really significant pullback, it could be a group worth looking at later.
Yeah, it does have that parabolic feel to it when you start looking at those 26, well, actually at bottom in 2014. Then you look at the bottom to 2016. I mean, you can just see that the angle of ascent just continues to grow. And
go ahead.
I think the good news is, though, is it's consolidating out of it and not dropping like a rock. But yeah, I think it's something to pay attention to. But that would concern me a little bit. But the fact that it's going sideways, I think is good.
Yeah, I always like these sideways consolidations. I mean, the market was taking off. If you remember back in 2013, that was one of the best years of this bull market. And you can see home builders didn't really participate. The next few years really didn't participate. But when they finally catch, that tailwind and start to take off, they can make some really big moves. And that doesn't just apply to home builders, but to any group that consolidates for a period of time. When they finally make that technical breakout, that can be the signal of something really good in that group down the road. So that was one area that I wanted to take a look at. Another is the DJUSES. And I was trying to remember earlier, because on the weekly chart, and I'll show you that in just a minute, but here you can see that the real estate services index been in a very nice uptrend for most of 2017, really throughout almost all of 2017, continued to perform well. And today it's having a pretty nice day, up 1.5%. We pull up the weekly chart. The rising 20-week moving average has just been awesome. And so when you think that a group can't pull back 10%, just look back to this one when it got up to about 162 in, July of 2017. And at that point, we were getting up close to overbought territory. Just one quick trip down to test that rising 20-week moving average was nearly 10%. That was done in about 2 or 3 weeks. So it does happen, even though it seems like it's not going to. From a trading perspective, you really need to have patience and exercise discipline, not chase these groups when they're overbought. But this is another group that tends to perform really well in January. Biotechs. Now, this one, I think, and I've talked a lot about Biotechs, and I felt like they were starting to strengthen, and they're trying to make a very significant breakout today. And I'm going to annotate this because we've got gap resistance and price resistance that the group is trying to negotiate right now. Here was a big gap down in October. Notice the failure right there around the 2025 level. We're trying to make this breakout on the Biotechs. And I think that could be very significant, because if we take a look at the seasonality chart of this group, and look over the last 20 years, first of all, January has been up 65% of the time for the Biotechs. Only July at 70% has been better. And when you look at the annualized or the returns, 1.3% in January, not bad in January. Keep in mind, January has not been a great month for the S&P 500. So the fact that this one's up 65% of the time and up 1.3% in January, followed by pretty decent February as well. This is a group that not only is looking to break out technically, but also appears to be pretty strong from a seasonal perspective as well. Then we pull up the mortgage Reits. This group is really struggling today, down over 1%. And since topping in mid-December, has been down probably about 4%. Pretty big drop here. But it has been moving sideways in a range. Potentially, maybe it'll get down to the price support area around 58.5, where it's been very strong. Again, we're going to go out to the weekly chart here. And from a weekly perspective, it does look like we're sideways consolidating after an uptrend. Got a lot of overhead resistance up around 64, 65 going across the chart. But to the downside, I would expect that 58.5, 59 area to hold. So we may get a setup here as we go forward. Another group that does pretty well in December. And then finally, the last industry group I have, and then I'm going to talk about some individual stocks. But the last industry group, this is specialized consumer services. Another one, negative divergence on the daily chart. So we're breaking out negative divergence, If we lose that 20-day moving average, we make it a 50-day test, which is down near 1320. But if we look at a weekly chart, that 13, we now have a 20-week moving average that's above 1300, about 1303. So if the daily chart is looking for maybe a test of 1320, that also would be an excellent possible entry on the weekly chart. So this is another group very, very overbought. Look at the weekly RSI, not far from 80. But if we get a pullback in this group, this would be one I'd want to keep an eye on based on its seasonality as well. Let me pull that one up and see what we had there. Let's see. So, well, it only goes up about 50% of the time, but it does average going up 2%. So it seems like when it goes up strong. When it goes down, it probably goes down a lesser amount. That's pretty strong when you look across the board. It is the strongest month of the year for the DJUSCS. So that's something to keep in mind. Now, I do have a few stocks that I wanted to go over that just do extremely well during this time of the year, and then a couple that don't do so well. I'm going to start off with Priceline, and I've talked about this one. This is one of the most amazing seasonal charts that I've seen. And when you look at Priceline, first of all, January is maybe 50%, 50-50, but it does average going up 5.4%. But look at February's average return of 8.8%, March 7.8%, and April 13.2%. And you can see that the percentage chance of it going up these months are the strongest of the year. So Priceline is just getting into its sweet spot from a seasonal perspective. And I know the stock earlier today was trading pretty nicely. If we can get back up through this reaction high around 1800 and get through that 50-day moving average, this one could be primed to do what it tends to do this time of year, which is move higher. Now, I follow technicals more than I follow the seasonal patterns. So when I see a stock that always does well in the first 4 months, I'm not just going to rush out to buy it. I still want to buy it at a good technical point. So I would be watching if we can get a breakout and see the volume coming in and clear, say, 1790 to 1800 on Priceline. I think that would be a very interesting technical development. So that's something to watch. Another stock, and I'm going to pull up the seasonal information, is Norwegian Cruise Lines, NCLH. I think I got it typed in here, right? It doesn't want to come up. Let me go ahead and pull up the chart first. We'll come back to this one. But you see a lot of price support here around $53, maybe $52, $53. It's moving up a little bit today, but still, from a seasonal perspective, let me try this one more time. There we go. Well, it's only got 5 years history though. So, but you can see January, February, March. Some of these I picked based on how they perform in the first quarter relative to the balance of the year. And the average monthly returns January through March here are very strong. Another one that we can look at, and I'll try to pull up some that have much longer history because I don't pay attention to the ones that only have 3 years. I'm surprised I didn't catch that earlier. Micron, 20 years. Look at January. Goes up 60% of the time, which is the tops going across all the months. And it averages going up over 8% during the month of January. Very strong there. Ross Stores, ROST. Of course, it's in the retail space, and retail's been doing very well. And you can see January, February, March. Look at how it picks up throughout the first quarter. Very strong seasonal period for Ross Stores that it has begun. Let's take a look at, I mentioned Netflix earlier, so let me pull this one up. Netflix just loves the month of January. Average is going up 18% in the month of January. Imagine just having one stock that does that every year for you. But it's been doing that every January. Well, not every January, but that's the average. And it might be that their first, this may be somewhat influenced based on maybe an IPO. It hasn't changed much over the years, though. Yeah, early on, there must have been a really big one. It's probably the one right there that takes it to 22%, then to 31%. So it looks like maybe, I don't know, maybe about 10 years ago, we had some pretty big Januaries. But the number really hasn't changed much over the last 5 years. I mean, so it just tells me that it continues to be very strong. We got an upgrade on Netflix today, so that's something to watch. A couple of stocks that don't do so well this time of year. First one I think you'll find a little surprising, Google. And take a look. Google, over the last 14 years, actually has negative annualized returns in both January and February, and just a small fractional gain in March. So the first quarter is not very kind to Google. You can see the end of the year tends to be where we see a lot of strength in Google. And then the last two that I have here, Expedia, kind of interesting that Priceline does so well and Expedia doesn't. But if you look over the last 13 years, January and February have both been negative, although we do pick up March and April when Priceline also does well. And then the last one I have is Intuit. And this is a software stock. Over the last 20 years, January's only been up 35% of the time, and its average going down 1.1%. So, and by the way, those individual stocks I looked at all came off the NASDAQ 100. So I was kind of featuring the NASDAQ 100 stocks when I looked for some of the strongest and the weakest as we head into a new year. So with that, Aaron, I know we have the 10 in 10. What was our first?
Yeah, I'll let you get that ready. It's Amazon. And then I do have a list of the symbols that Tom covered. He may not have been able to get to all of them, but this chart will be in the Market Watchers Live recap if you wanted to go in and take notes. And with that, now I would say the 10 in 10 is ready.
All right, let's do it.
Okay, so your very first one, of course, is Amazon, like I said.
All right, let's take a look at Amazon. I think Amazon's in a bull flag, so I have no problems with this one at this point. It may consolidate a little bit more. There's a top that we're going to have to negotiate. You can see pretty good volume as we moved up and started selling off. So it's going to take a little bit of something, maybe even some kind of a catalyst to get us through that 1200 level with some gusto. But I think this sideways consolidation is doing a lot, though. The MACD, you can see, is working its way back down towards zero. We continue to work on this short-term trend line, uptrend line. Let me point that out here for you. But I would say, this low here coming across. So I think we're just slowly working our way back up toward this breakout level at 1200. So I'm pretty bullish on Amazon, as I am most stocks as we go into 2018. And so I'd be looking for that breakout.
Okay. Let's see. The next one will be Bluebird Bio, and that's blue, BLUE. It's sitting right on some nice support at this point.
Yeah, actually, I love this chart. I love it so much I might take a look at it myself later. This one really looks good. I like that hammer that it's trying to put in at the 20-day moving average. The huge gap up. I mean, you can see that black candle. Anytime I see that black candle, I'm going to look for more weakness. It doesn't always happen, but from a risk reward perspective, it makes sense to respect that kind of a candle. And a black candle it's a filled candle, number one, so it's telling you that you close way below the open. But normally with this kind of gap up and that heavy a volume, and the high was basically the open that day, it just tells you there's a lot of resistance there, and that we're likely to continue to see some weakness. So what I find interesting here, though, is you've got gap support around 170, and you've got the rising 20-day at 177 and change. So I think the combination of these two are great support levels, and the top of this candle at 220 is going to be my target. So I think blue looks really good. I'd be a buyer.
All righty. The next one's also sitting on some nice support. Meritor, MTOR. I just got a PMO sell signal, though, so that would worry me a little bit, but it's holding support.
Yeah, this one's in gap support, so it keeps struggling at the 20-day, and I forget which stock I was looking at earlier. I think it was Red Hat, actually, that was down below its 20-day on some pretty heavy volume. See this break right here on the stock with the volume picking up, and then as you get up, we did make it through one day above the 20, but that's where we're generally struggling, is to get back through that 20-day. I think now the MACD is starting to get a little bit better. This volume to the downside is not worrying me. I would just say keep a fairly tight stop around that 22.5 area, especially if the volume picks up and we lose that on a closing basis. Otherwise, I actually think we're going to make another run. I think this is going to turn out to be sideways consolidation, the bottom of the range 22.5, the top of the range near 27. So I would be looking for another test to 27, maybe sometime here in the first quarter of 2018.
All right. Let's see, the next one I have is GlaxoSmithKline, GSK, gapped up above overhead resistance and sitting there on what now is new support.
Yeah, I like the move through the 50 and I like the volume coming in. So those are two positives. It's been in a big downtrend and we've seen a huge amount of selling on the stock. So there's clearly going to be some overhead resistance. And I think the big resistance is going to be felt between these two candles. So I'm going to say 36.75 to about 37.60 is going to be overhead resistance. If we could push through that, I think that'd be very bullish for the stock. I wouldn't look for it on the first test, though. I think we'll probably get stuck in there, pull back, and then we'll see what the stock's made of.
All right. For our Canadian friends, and everybody's talking about it, of course, the weed stocks, marijuana stocks. This one would be ACB.TO. And I know here in California, it's now been legalized. And so we'll have to see how that goes. But I know a lot of people are looking at this industry now.
Well, price support is going to be around 8.5, and this stock it is very volatile. So you got to be willing to take on that additional volatility. You can see also some pretty big volume on the move to the upside here. So maybe even the bottom of the gap support. I'm going to say 8 to 8.5 is where I would want to give this stock to the downside. And I also always talk about this rising 20-day, but you can see after it made a huge move back in November, it was way above its 20-day, and literally 2 days later, it was right back down on it. So I just don't like to chase. I'm not going to chase with a stock like this that's so overbought. Not to say it can't go higher. I just think you take on a lot of risk if you want to get in at this level. So I'd wait, and I think the 8 to 8.5 level on any pullback would be a much better reward to risk entry.
Okay. The next one I have for you, and I actually had to put it on a log scale so I could see what was going on with it. Rite Aid, RAD.
Yeah. Well, got some volume coming in. Maybe 2018 is going to be the year. We've been acting more bullish on this stock recently with this successful 20-day tests and with that golden cross, the 20 over the 50, and it holding as support. So the movement to the upside today is good. I think 2.25 is the big level, though. That's going to be the key area to try to get through. You can see multiple tests at 2.25 here, July and August. We gapped down below it on heavy volume. We failed at 2.25 with heavy volume late November, early December, and now here we come back up again. I think if we can break above 2.25, given the bullish, what we're seeing out of this stock over the last 6-7 weeks, it's been acting much more bullish. I think a breakout would be a great sign for the stock. So I'm growing a little bit more bullish to stock for 2018, and a breakout above 2.25 would confirm it for me.
Sweet. All right. Next one I have for you is AMC Entertainment, which is AMC. It looks like it's stuck on some overhead resistance there. I don't think I'd be looking at it as a potential buy just yet.
Yeah, I would agree. I think that it's getting up close to resistance. There are a couple areas, we're in a downtrend. And so when I look at a chart, that's the first thing that's going to bother me is why are we downtrending in a bull market? What's going on here? We gapped down on massive volume in early August. This was the prior low before the gap down. So that's going to be a major overhead resistance. Here was your reaction high. And by reaction high, I just mean after the sell off and all this volume, this was the highest level we could get to before we started selling again. So that reaction high is 17. I think the 17 to 19 range is really big on AMC. Could we get there? Yes, but you are in a downtrending stock. So I just think there are too many other stocks that I would be interested in. I would pass on this one.
Okay. See, the next one I have Taiwan Semiconductor Manufacturing, TSM. Interesting breakout. And man, the PMO really acted very strange, and it's in oversold territory and just got a PMO buy signal. So it looks pretty good as far as DecisionPoint.
Yeah, I think this one looks pretty good. I think that the uptrend that we had, I always look when I see a stock like this that continues to uptrend. I mean, keep a couple things in mind as we made this breakout, the last move to the upside. Look at the MACD. I mean, it's horrible. Negative divergence. We really needed a pullback. We got that. But I think what I look for continuation patterns when I see an uptrending stock that's, currently going through some weakness. So when I look at TSM, I would be thinking, maybe something like a cup, where we're starting to turn back up, volumes coming in on the right side here now. I think a move back up to 43 would be incredibly bullish and would complete a cup pattern and then maybe a pullback to that rising 20-day might be entry. You could, more aggressive entry would be to jump in here on this move today with a breakout above this recent consolidation, because it certainly looks like it's forming the right side of a cup. And that pullback came right down to a pretty key price support area at around $38.50.
Okay, two more left. Let's see, EWZ, the Brazil iShare ETF.
All right, EWZ, another one that's breaking out over that recent double top after pulling back. So let me see, I would probably draw a line. I think as long as it continues to hold that double top breakout right there around 40.5, I'd be pretty bullish. I think also the trend line, the previous trend line, downtrend line was broken. They're just kind of coming across there. So I think this one's looking really good. MACD's broken back into positive territory. And again, off of an uptrend, we were moving lower for a while within a channel, but now we've broken out and continue to push higher. I think this one looks bullish.
All right, last one. It's the Spider Barclays Long-Term Corporate Bond ETF, SPLB.
All right, SPLB. Well, I'm not a big fan of these just because I think you can make a lot more money in stocks. But the uptrend has continued in play. You do have a double top, but I'm not seeing anything horrible. I'm trying to look for what the key would be for me, maybe, and it probably would be trend line support. So I'm going to draw a trend line. Maybe it goes from about here up through this level. Because I think if I grab this and drag it up here, we got pretty close to a channel that we're in. So I'm going to say as long as this holds, this channel holds, I'd be okay with it. We're right in the middle of it right now. But the movement to the upside is not real fast. So it just depends your own investing strategy. I consider this one a hold. It's not something I would be rushing into, but I think it still looks okay technically.
All right. And that, I'm going to share my screen real quick, concludes the 10 and 10. You did pretty good, Tom. And you're sick and everything.
I was trying, that's one of my New Year's resolutions is to try and get that down from 10 and 13 or 10 and 15 and try and get it down to like 10 and 11.
Yeah, we're getting there.
Yeah.
I think we are.
One day anyway.
Yeah. Okay. So here are the symbols we went over. I'll also have this chart in our Market Watchers live recap. And the symbols and those annotations will also be put in our Market Watchers live chart list. And with that, I'm going to go ahead and go into our final market update. Let's see what is going on with the market right now. And I'm going to take us to the member homepage, and the candle glance, can get to it right here. I think this is the best page to let us know exactly what is going on. So as you can see, I mean, we had a really great open for most of the major markets, but boy, the Dow has really pulled back a lot of those gains, and it's currently up, but not like it was in the morning. And you can see the S&P 500 consolidating sideways, not really taking much of a decline after that run up in the morning. And we can see NASDAQ same. Consolidating after that nice run up. Russell 2000 pulled back, but it's still holding on to most of its gains, currently reading 1546.45. Wilshire 5000, same nice move up, consolidating sideways. Treasury yields are rising steadily today, and we can see currently reading at 24.74. UUP is moving sideways after a very large gap down, but it looks like it has found a support at this point, currently reading 23.93. Commodities are up slightly. USO, you can see it's been a kind of a volatile morning here, up and down quite a bit, but currently up 4 cents at 12.05. GLD gapped up and has been consolidating ever since. And we can see the volatility index had spiked last week on Friday, but it has come down and now reading again, actually under 10. So we're at 998 for the VIX currently, and advances are leading declines. I want to go ahead and take a quick look at our market summary here, so we can see how those international ETFs are shaping up and the different industry groups, how they're lining up as well. So we can see as far as major indexes covered here, NASDAQ 100 having the best day with the transports not too far behind. We can see that sector spiders, consumer discretionary and energy, all up over 1%, 1.3%. Utilities are the laggard along with consumer staples. Not a surprise. You do generally see these two travel in different directions somewhat. We've got U.S. industries, natural gas, disk drives, and gold at the top. Not surprising, we saw that GLD chart. Insurance and utilities are the laggards, currently down over 1%. As far as our international ETFs are concerned, China and Brazil are leading the way. And we did look at the Brazil ETF earlier in the 10 and 10. We also have France, Netherlands, Switzerland, all are laggards, but only France, that ETF is down. Every other of the international ETFs we cover here are in the positive. And you can see as far as commodities, though, coffee, natural gas doing quite well, gasoline on the bottom. And that pretty much concludes our final market update. And with that, I'm going to go ahead and get into the DecisionPoint report.
Hey, Aaron.
Mm-hmm.
Before you get into that, can I just wanted to show two quick things.
Absolutely.
Okay.
That'll give me time to get ready.
Yeah, go ahead and get ready there. First thing I wanted to show everyone is that on, I'd mentioned this before, but January is the best month of the year for the NASDAQ. December is the best month for the S&P 500 and for the Russell 2000, but the NASDAQ tends to outperform significantly during the month of January, and we're seeing that today. So I wanted to point out this chart. This is a seasonal chart where you can compare one index to another, or a stock to an index, or a stock to another stock. And what this seasonal chart will do is will tell you how these two compare to one another. So I've pulled up the NASDAQ, and then I've also I've compared it to the S&P 500. So when you do that, originally you'll come up with the 5-year standard chart, but I've just taken the slider and I've dragged it back to 20 years. So that what this is telling you is over the last 20 years, how has the NASDAQ performed relative to the S&P 500? And if you look across here at the bottom, you'll see that January just sticks out like a sore thumb. The NASDAQ has completely swamped the S&P 500 during January. June is the only other month that's been up more than 1% on average. Remember, these are averages. So what this is telling us is over the last 2 decades, the NASDAQ's January performance is up more than, well, almost 1.5% above the S&P 500 on average. So that was one thing I wanted to point out. The other thing is you were mentioning consumer discretionary and consumer staples. And one of my favorite relative ratios is the XLY versus the XLP in order to determine the sustainability of a bull market. And with this move today, with consumer discretionary swamping the staples area, you can see that we are now making a breakout to a 5-year high on this ratio. And that's just simply telling us that money is moving more toward discretionary stocks than toward staples. It's setting a new high. And when you think about these two groups, consumer discretionary stocks are companies that sell you the things that you want, not that you need, but that you want. And you're not going to really buy those things, or the market's not going to anticipate you buying those things unless the economy is anticipated in strengthening. So if the market is anticipating strengthening of our economy, then this is what you typically will see, the XLY outperforming the XLP. And we've got that right now. So this is another one of those signs to me that is painting a very bullish picture as we head into 2018. So with that, I will turn it back over to you for our first decision report of 2018.
Yes, and actually, I'm just gonna steal straight from our blog, Carl's yearly wrap. Normally, it's the weekly wrap, and he looks at weekly charts. But since we had the end of the year and the end of the week and the end of the month all happen on the same day, he did daily, weekly, and monthly charts in there. So I wanted to go ahead. I'm not going to reinvent the wheel here. I'm going to use the charts that he came up with. So you can either find it here, it's under popular articles currently, but if it isn't there, when you go back to look, it's in the DecisionPoint blog. And that's how I'm going to get to it right now, just so you can see how it works. So, All right, so I'm just going to click here on the yearly wrap. What I thought was interesting is that when I read this, Carl is of the opinion that this year is not going to work out so well. And I'm going to show you some of the charts as to why he thinks that. So he was noting here on the SPY, and this is the daily chart. We technically broke down out of this rising wedge, but as he said, we got drift. So we really didn't get the breakdown that you would expect out of a rising wedge. So he thinks that we're still vulnerable to that. And Friday, I did get PMO sell signals on the S&P, the OEX, and also the Dow. All of them had PMO sell signals at no overbought territory. And the SPY was no different. As you can see, we have a sell signal in overbought territory. So that is certainly a warning going into this month. And this is why I think it's interesting, Tom, because you showed us those seasonality spreadsheets, and it's all food for thought. It's all something you need to think about. What he pointed out here on the daily chart, actually, it's a longer term daily chart, I think. He's really worried about this parabolic that has slowly been forming over time here on the SPY. And we just now got, it's sliding sideways and has come out of it. It hasn't actually broken down at this point, but that's something that we should consider as well. And then there you go, that PMO sell signal sitting in there. As far as the weekly chart, I see this as a rising trend channel. I think he's drawn it. It's a little bit of a rising wedge. But, at this point, it does look as though we need to come down here and test the bottom of this rising trend channel. And so we'll have to see whether that's going to occur now or later. But, the cool thing is, the good thing here is, forgive my California lingo, the weekly chart, you can see that the PMO is rising nicely. And as far as the monthly chart is concerned, again, I think, and he didn't actually annotate it, but I think you can see that sort of parabolic shape that we're getting off of the SPY. Now, I'm not looking at these parabolics personally as, typically a parabolic, you're going to just, have a huge correction, usually back down to the last area of consolidation. So in this case, if you started your parabolic move over here, that would mean that you'd have a decline or a correction all the way down here to that 120 level. I just don't see that. I really don't see that. Carl does not see that. But it is concerning when you see that the angle of ascent continues to get more and more steep. That means it's going to be more and more difficult to maintain. And right here we can see, let's see, what did he go over here? Our short-term indicators. Right now, I've been watching them very closely as well. They've been mainly in decline. And look at this in the thumbnail right there for the consolidation. It happened. They started down. Let's see, we got the second top on it, and that's when we started to see some problems. And, all of them have been trending down really since mid-December. So we did get some warning, I would say, about this area of consolidation, or a pause is how I was looking at it before vacation. And we can see a PMO also. Again, I'm just pointing this out because I think it's very important. We have a PMO sell signal in overbought territory. Intermediate term indicators are really concerning me right now. We saw them tick lower. We saw them curling over at this point, but we didn't have the negative crossovers. And the ITVM is just about ready to have that negative crossover. We have a very clear round, top right now on these indicators. And typically these tops on these indicators are pretty accurate as far as developing problems in the intermediate term. And you can see when we topped here on these indicators as they were topping, that was when we started this consolidation area. So if we're going to move, if these indicators are going to continue lower, I think that would also be a problem. We're looking at consolidation right now, but I would start looking for possibly, and I know, imagine this, a real decline and or pullback, or even a corrective move. I'm not of that opinion. I like the seasonality you were showing, Tom, and so I'm not going to be looking for a correction this coming month. But I think that the market is starting to get a little bit weaker. We're going to come into this. We'll have to see how interest rates affect things, the tax plan, so many things going on that could be a problem. So I just wanted to point out those indicators, the fact that intermediate term is telling me to be concerned about the upcoming month or two. And so let's look at UUP. And again, this is really very nice. We get to look at a daily, a weekly, and a monthly chart because all of those signals closed out for us on Friday. So let's take a quick peek here. Now, the dollar, we've been having trouble with this. I've been bearish on the dollar for quite some time. He's annotated in a long-term declining tops trend line that is held nicely as far as overhead resistance is concerned. And now we're starting to see that move to the lower. Now, I do want to make mention as I'm going through these charts are from the blog. Okay, so they're going to read from Friday. So these aren't today's charts. So I just want to make that point. But what I want to do, I'm looking at an intermediate to longer term view, and I want to see what's been happening at the end of the month, the end of the year. So that's why I'm going ahead and using Carl's charts at this point. But you can see it's now dropped below this short-term support, and it does look to be heading down to that 2360 level to test those September lows. Look at the weekly chart, okay? The PMO has topped below the zero line, which is a problem, as Carl noted. We are sitting on some very important support, in my opinion. This, of course, is the most important. If we got a breakdown below this on UUP, below that 2350 level, wow, look out below. So at this point, we're holding on to support there at that $24 level. But, when you see a topping PMO like this on the weekly chart, that also should give you some pause. And when we look at the monthly chart, Carl says this is a very bearish chart. And again, I have to agree. So we had the rising wedge, it executed. We found support here, and there is that area of support currently lingering here. But look at this PMO, top below the signal line, and is continuing lower. It is still above zero, but it's pointed down. I wouldn't be looking for this area of support to hold. If anything, we're going to have to test, I think, these tops back here from 08, 09, and 2010. So that's the support level I'd be looking at next. Gold, let's get into gold, the daily chart here. Really nice breakout. I've been bullish on gold since we got that bounce off of, and you can't see that support level on this chart, but I used a volume by price bar, and that was right where you would expect support to be found if you didn't have price support easily viewable. That's typically when I get involved in that. You can see the 20 is about to cross above the 50-day EMA. I suspect I'll be writing a DecisionPoint blog, excuse me, about a new intermediate term trend model buy signal on gold. So that's looking very good. He says that we're still looking at nice, what we consider bearish readings as far as gold sentiment, because we're looking at the current premium and discount on the physical gold trust. So it's a closed-ended. So we get to look at the discounts and premiums that it's selling for at this point. And right now, the discounts are very high. And so that gives you the opinion that there is still some bearishness out there if you consider that the discounts are still there. We're getting that move up. This was a declining wedge. Technically, I think you could have made a case for. We got the breakout now. We're sitting at that 1310 overhead resistance level. I think this looks like a good chart. I'm looking at that PMO buy signal. PMO is now above zero. We haven't seen that in a while. I'm looking for gold to test that high from back in September. Let's look at the weekly chart. And again, we had that. It was very encouraging when we got that breakout above the breakout from that long-term declining tops trend line. And you can see this was the area of overhead resistance that I was watching for, as was Carl, but we didn't quite get there. but I think that's okay. He's suggesting we have a symmetrical triangle here. We're on the way back up. Look at the PMO. It's now bottomed. So that looks good on the weekly chart for gold. All right. So this was an interesting chart, I thought, because he showed that parabolic that came into play with gold and how it did drop and correct. And this is what we're talking about when we look at the current market situation with the S&P 500 and most of those major markets. If you start looking at those monthly charts, you can start drawing in and you can see a parabolic move, not just a general rising trend channel. Those rising trend channels kept getting steeper and steeper, and they're still getting steeper. So we have to watch out for that. And you can see that when that parabolic broke, it broke, and we ended up coming all the way down. Again, like I said, you usually get down to the next area of overhead resistance / support where it was moving sideways. And so in this case, that's where we fell to. And we've been making our way back up, but that overhead resistance there at that 1400 level is, it just seems that it's very difficult at this point for gold to reach there. But I think given this breakout from this declining tops trend channel, a rising PMO, I think that it's very likely we will see 1400 on gold going into the year. USO, crude oil. Breakout from a symmetrical triangle. It's continuing higher. Got the PMO buy signal, so that looks good. You can see the EMAs are really lined up nicely here with the 20, 50, and 200. When you look at the weekly chart, we're now right up against overhead resistance that was formed pretty much in 2016. And it's been moving. It gets close to that $12 mark, and then it fails. And we'll have to see if this will be the exception. I'm a little concerned because the PMO, while rising, is technically overbought when you're looking at the last 5 years. However, I suspect when you go to a monthly chart or when we look at the monthly PMO, it's a different picture. So you can see as far as the monthly chart for USO, you can see that up here. Remember that channel, the trading range that we've been in. And here's how it goes to the monthly chart. Got the buy signal, and the PMO is rising nicely. It's in negative territory, but it looks like we're in a position where we could finally break out above that $12 level on USO. And I think it would be very bullish if we do see that breakout occur. TLT and bonds, our last one. And what Carl was pointing out is this double top. I think you could even make a case for a triple top here. Excuse me. Getting over colds as well over here. And you can see the double top. He's leaving it in there because we still could, we got this bounce. We didn't go down to test that quote unquote neckline, that confirmation line as he lists it for the double top. But it could end up being just complex, if we don't get up to those areas of overhead resistance this time around, or even if we do, that could be the top is still forming on that second double top. So that's how I'm looking at it at this point. We got that break back above that rising bottoms trend line. I think that is positive. And then you can, of course, see for TLT that we have the PMO is turned up, and it does look like it's getting ready to go in for a buy signal. So we can see on the weekly chart, as Carl mentioned, we're seeing some price strength. The PMO is still, kind of anemic at this point. I'd like to see a bit more movement out of it on the weekly chart for TLT. Looking at this, it looks like we're probably going to be testing this rising bottoms trend line next to up, like we were saying, as a possible double top here. So I'll be watching that closely. If we get a breakout above these two tops, well, of course, that would, in my opinion, disintegrate that double top pattern. So we'll be watching that area of overhead resistance. The PMO is on a buy signal for the weekly. It's certainly plausible. But when I look at this monthly chart, it really worries me. We got that parabolic move. You can see that he has marked. We got the we got the collapse, as parabolics generally will collapse in a very short time. And now we've been consolidating sideways. Look at this thumbnail. I have to say, this is pretty much, in my opinion, a textbook reverse flag, which is a bearish formation. You've got, I can't annotate the thumbnail here, but you can see that you have kind of a rising flag here, the tops and bottoms. That's what typically you'll get off of these really these long flag poles. And so what we'll be watching for is if we get a breakdown, I'd say the flag would execute somewhere around here. If we get a breakdown below 148, I would be thinking about look out below. It would make complete sense. You can see the length of that flagpole if you added it to that breakdown point. That would actually bring you down below this rising bottoms trend line or this rising trend channel. I don't think that will happen, but I think that it's certainly reasonable when you look at this monthly chart to think about 2018 being a real problem for bonds at this point. So I'm not sure what your take is. I know, especially on bonds, because I know you look at the yields all the time, Tom. But when I look at this monthly chart, it just does not look good for bonds going into the year, in my opinion.
Yeah, I mean, I like to follow the bond market just because a lot of the money that moves into the stock market comes from the bond market. So I like to look for the signals that are going on in the bond market. I don't trade bonds, and I think there was a question in the room asking me, whether or not I do anything with fixed income investments, and I don't at this point. And I'm so active and so close to the market, and I try to limit risk with some pretty tight stops, short-term trades. I'm not sure. I haven't really thought too much about fixed income. I mean, I'm 56 years old, so not. I guess I'm in the second half. I guess the second half has started, but I'm not really looking ahead at this point in fixed income investments. I enjoy following and trading the stock market, and my investments in the stock market and the way I trade and the risk that I take changes based on conditions. So I don't really look ahead and think about moving more into fixed income investments. That's just not my style. But I guess if that changes, I'll let you know. I know that there was one question that had come in, Aaron, for me that was asking about the dates and why did I choose the dates that I did. I guess they're referring to the October 28th to January 18th information that I was showing earlier. I keep a spreadsheet of all activity on the S&P 500 since 1950. It's a daily spreadsheet. I have every day's action on it. And so I've gone through and analyzed. My background, I'm a CPA, so this is kind of stuff I enjoy doing. I just manipulate the data and run some different formulas against it and blah, blah, blah. But what I found out pretty quickly was that the stock market has a tendency from October 28th to January 18th to rise, unlike any other period during the year. And I think I had said before, even before this period started or about the time it started, I pointed out that the S&P had gone up 57 times in the last 66 years, if you look at that period. So it is a very influential period in terms of how the performance is going to be in the stock market that year and into the next year. So what I did was I was just looking at, okay, what's the tendency for the market once we get past that period for the next 3 months? Does it matter how much we've gone up? And what I found in that study that I did was that actually the stronger the period is from October 28th to January 18th, the stronger the following 3-month period seems to be. So that's how I'd come up with those dates and all.
Yeah.
But I know we've got about another minute or so here, Aaron. We didn't really talk about forecast, but based on what you were saying, you think the market's going to move lower the balance of this week?
As far as I'm looking more in that intermediate term time frame, and I think January is actually going to be a tough month for the markets. That's sort of what I'm looking for. As far as this week is concerned, it looks like everything, is fairly soft. I would be looking neutral into this week. Really not a big move up or down.
All right. Well, I'm a little bit more bullish. I'm following the seasonal pattern. I do expect the Nasdaq to lead again. I think this is an early indicator today of what we're going to see in January. So I do think the market's going to break higher. I think we're going to see some more all-time highs, and so we'll kind of we'll be on here talking about it every day. A couple of quick notes on some upcoming events tomorrow. we do have everything stock charts. Bill Shelby will be with us tomorrow and give us the latest there. Later this week, Aaron will be conducting a workshop on Friday. We'll talk about that more as the week goes on. And next Wednesday, Bruce Frazier is making a return visit to Market Watchers Live. He'll be with us next Wednesday, January 10th. So really looking forward to hearing from Bruce again and seeing what his forecast is for 2018 and things that he's looking at. I want to thank everybody for stopping by. Really appreciate the support that you've given us since we started Market Watchers Live. We do love doing the show, and we love getting your feedback. Please remember to complete that survey as you exit. It's in the lower right-hand part of your screen. As you fill that out, we do go back and look at all the comments and try to incorporate some of your suggestions in future shows. As a reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everyone. Again, Happy New Year and happy trading.